Now, charting is quite unique, and it's one of the tools that you have to master. As recently as the early 1980s, brokers and traders charted the movement of assets by hand with nothing but a piece of graph paper and pencil. And I've been trading since 1983. And we used to sit we didn't have computers. I mean, we didn't have internet. We didn't have PCs. You had, a great big air conditioned room with this huge computer in it. And you had these, green and white DOS screens, but they didn't have any programming to do charts and graphing. And we would actually sit in the pits with our graph paper. So we could only trade a couple assets because you could only keep your charts up to date on a couple assets. But the markets moved slower. The world was a different place. But we did all of our charting by hand. But that also meant we used a lot less technical indicators because we didn't have the time to do the calculations. The most we had was slide rules and a variation of a pocket calculator. Okay. But in less than 4 decades, the charting industry has been revamped several times, which has led to intricate, complex tables for traders to decode today before executing currency trades. With the development of Java charts and HTML charts, and with all this new online trading, well, it's not so new anymore, but the more and more advanced platforms we get and the more advanced charts we get, the more data we're getting fed to us in every which direction, and the more data we have to learn to interpret. Now, today's data feeds and advanced computer programs offer all traders the most sophisticated charts with easy to add indicators and overlays. And one of the advantages today to online trading is we've actually been able to step into where the professionals and the brokerages and the hedge funds were, because they had these computerized services and data feeds, and they were getting data. I remember when once a week we would receive a booklet in the mail of all the up-to-date charts and prices on commodities. We would sit there and wait for a fax to come in from the USDA, U.S. Department of Agriculture, with the latest crop reports. And because the broker I worked with in those days was a leading broker, he would get that fax faster than other people. But sometimes there was no financial news. There was no television channel you could turn to. In those days, we had television channels, but there was no financial news. There was no internet to get the stuff. But today, as an online trader, you have access to the same charts professional traders, banks, and hedge funds have. And if you don't take advantage of this, then you're making a big mistake. Charting software allows those in any market to see price moves, observe changes of various stretches of time, and combine this information to conduct market analysis and predictions. It's an absolute necessity for carrying out intelligent trades. Without it, trading currencies or commodities or CFDs will be a lot like gambling, highly dedicated to chance. Now, I need to stop here for a second and share with you a piece of information. Now, I can't say always, I can't say 100%, I can't say 95% of the time. I can only say what you should be aware of is, and we're going to talk about charts tonight, but it's the data being fed into the charts that is so critically important, and the speed in which that data is fed. Now, nobody out there, or on the whole, is trying to pull the wool over your eyes. But when you go to charting services, especially free charts like you're using on investing.com, or you're going to TradingView, okay, they are delayed charts. Nobody's trying to get over on you, but the fact is data feeds are extremely expensive. They're extremely hard to store, and they're extremely hard to get it up to you fast enough. It's very, very costly. So when you're using free charts, they have a few second delay in the data. Now that few second delay makes a huge difference in their costs. If you go on TradingView and you have a free account, sometimes they'll tell you it's a 5-minute delay. Nobody, like I said, is trying to pull the wool over your eyes. But if you're not paying for a decent charting service, then you know, and the difference between the prices of charting services and the levels are the data feeds. So one of the most important reasons to use the charts on your platform provider, especially like AvaTrader, is to see they're getting all of those feeds anyway, because they have to have all of that data fed in to, to facilitate trading. So they're just taking that same data, this instant data, and they're paying for it, and they're also feeding it into your charts. So you'll also see that, sometimes somebody will say, well, I was doing this and this and this on my trading view chart, and when I went over to my platform chart, the price was different. It's only because of the delayed feeds. So you should always be using those feeds on AvaTrader or the charts on AvaTrader. But you need to, now that you know one of the background pieces of information trades of charting, you have to expect to spend a lot of time reading trading charts, which is much like learning to read a new language. Nobody out there, no matter who you are, can avoid reading charts. Okay, it's like taking the most important tool you have and throwing it in a trash can. Now, if I said to you that the euro was trading at 104.77, it opened at 104.72, it closed later, or at noon it was at 105.44, but at 1 o'clock it was, the high was 104.47, and at 2 o'clock the close was at 104.76. Can you repeat anything I just said? Can you even make any sense out of what I just said? Can you see any commonality in what I just said? Nope. Because our brains can't turn those pieces of information into visual pieces, visual charts, visual graphics. But when we put these on charts, we can then see price. We can see what price is trying to tell us, and we can observe or absorb a huge amount of data. Now, there are different types of charts used in technical analysis of the CFD market. Some of the most common ones include line charts, bar charts, and candlestick charts. These are the three main categories of charts. Line charts we're going to briefly go over because line charts are unimportant. They can't help us. They show us a general movement of price, but they have no important information on them that we can use, because you only take a dot at the closing of each period and connect those dots with a line, and it doesn't tell you anything really about what's happening. So we come to the most common, which are bar charts and candlestick charts. Now, there's many different variations of bar charts and candlestick charts, but they all have the same basics. Okay? Because all we have are four pieces of information we can put on a chart. Do you know what they are? It's the open, the high, the low, and the close. So on this chart here, which is a line chart, I have very little choice on what I can do. What I see is just the dots connected. The bar chart and the candlestick chart use four of the same pieces of information: the open, the high, the low, and the close for whatever time segment you're looking at. But that's all the information we have as traders: open, high, low, and close. Whether you're using a bar chart or candlestick chart, they give you they're based on the same pieces of information. Nobody has secret information or secret weapons. So as I said, a line chart is just good for giving you a quick view of the overall markets. You can see a downtrend, you can see an uptrend. Bar charts, like I said, use the open, high, low, and close. Sometimes we refer to as OHLC. To make a bar chart, we put a dash to the left at the opening price of whatever time segment you're looking at. We're looking at a 15-minute chart, it's the beginning of that 15 minutes. We're looking at a 1 hour chart, the beginning of that 1 hour. We put a dash to the right at the close of whatever price it is at the end of that 1 hour. We put a dot at the highest point it achieved and a dot at the lowest point achieved, and then we connect these dots together with a bar. And this gives us the open, the high, the low, and the close for that time period. Not complicated. But what we start to get with bar charts is we start to be able to see commonality. We start to be able to see price. We start to be able to decipher what price is trying to tell us. But then we go on to what is the most favorite type of chart for online traders. I don't particularly know why. Well, I do know why. It's because it's colorful, and people think that they can look at this candlestick chart and make trading decisions. What they don't understand is you can't just look at a candlestick chart and make major decisions. You have to learn to use a candlestick chart. Now, on a candlestick chart, we put a line across at the open and a line across at the close. So instead of a bar chart where we're putting a dash, we're putting a line. We still put the dot at the highest point and a dot at the lowest point. We connect those dots to the lines and connect the lines to the other lines. And we use the open, the high, the low, and the close. Same information as a bar chart, OHLC. Now the difference between a candlestick is we form what's called a body. Because this high is still the same high. The low is still the same low. The open is still the same low. If the body of the candle closed higher than the open, in other words, you stepped up the ladder, you would fill it in as green because it was a positive time session. If the opposite happened, you would fill it in with red. And that would have been a bearish time session. So let's go over, let me pop up some live charts here for you. And let's see if I can just show you all this. Okay, so let's start off. This is my teaching charts, Euro US dollar, 30-minute chart, and we're going to start off with a line chart. Okay, just what we were talking about. Now there's variations in a line chart. And some call it, use the area chart. It's simply a line chart with the bottom half colored in. Then we can go to the bar chart. And a bar chart, same information, but we have the bars. Now, what I was saying earlier is that now that we have these computerized Java HTML charts, we're getting too much information and data. And this is allowing us to get way far off of the mark when we're trading. Because see, we have this open, high, low, and close bar chart, OHLC. But today's newfangled charts, and only because developers aren't really traders, they think they can give us anything. So we can have, and a lot of systems do this, and they'll give you a bar chart with the same colors as candlesticks. Well, to me, that's defeating the purpose and getting us way offline. But some people are using it because we have too many choices. But let's go back to the old standard and keep them with black on black. But you can have thin bars. You can have all the, everything just allows you to do way too much on charts today. So I say stick with the basics and you'll be okay. Now this is a line chart. Now, what most traders don't realize is line charts also have patterns, just as if candlestick charts. Now let's go over to the all-time favorite candlestick chart. Now this chart is identical to this chart. Same data, same piece of information, but it's colorful, it's pretty. And this is why traders like it. And they think by seeing how much red or how much green is there, they can make trading decisions. But candlestick charts are they're very nice charts, except you have to understand a lot more, because candlestick charting is all about not the amount of red and green. It's actually unimportant. It's about the different shapes and sizes of the candles and the bodies of the candles, and what the preceding candle is and what the next candle does to form candlestick patterns. So this is a very distinct two candlestick pattern. It tells you something about a market. This is a very distinct two candlestick pattern. But if you notice, we have candles with long bodies, and that candlestick right there actually has a name because it's a very unique candlestick when you have no wicks. Okay, and it's called a Hammurabi, and it tells you something about, it's called a Marabuzu, and it tells you something about what is going on in the market. We could say that these are called three black soldiers. Okay. So there's many things we can see. So we want to look at the patterns, not the reds and greens. Most candlestick patterns have nothing to do with what color the next, in a lot of cases, has nothing to do with what the color of the next candle is. It's the relationship from one candle to the next, the size of the bodies and its position and the pattern. Now, candlesticks work very, very well, but you have to keep in mind that you don't let your human nature, our psychology, take over and we start trying to figure these out by the abundance of reds and greens. But if we go back to a bar chart, let me just erase all this mess. If we go back to the bar chart also has, what most people don't realize, it also has definitions of patterns and how the bars are attaching together. I happen to be a bar chart trader. Okay. I just like it that it's not as cluttered up with the candlesticks. I can see common prices. And what happens is you can start seeing what price is telling you, because you can start to see, look at this step up here. This is a beautiful interpretation. You can see, you could have predicted every low that happened in that market. You could have predicted every high in this entire trading session of a couple hours, and you could have made smart decisions. You can also see prices that were important that become our support and resistance levels. Okay. You also see these in candlesticks, but the colors of the candles tend to keep your eyes very busy. But today with our marvelous charts, see that? I can do that, and then I can click over to my candlestick and have the same thing. So I tend to draw my lines, draw my trends, do all of my stuff on bar charts, and then click over to candlesticks to see if there's anything the candlesticks are trying to tell me. But now that you have some basics of the three types of charts, let's go back to my PowerPoint. Uh-oh. Now, remember, candlestick charts are the most popular of all three major chart forms for online trading. And as such, they are the type you will most often see as you trade. And a lot of times, most of the literature you see today talks about candlesticks. So as I said, traders love them. Candlestick charts are highly informative. It is not the only information every chart element contains, but also regularly repeated patterns that help traders see oncoming changes. These patterns help to see short-term direction and predict bullish and bearish trends. Just one element, a candlestick, is able to reflect many parameters, such as the market's open, high, low, and closing price over that period of time. The color of the body indicates the results of the close, when the candle is black or red. Now, that's the other thing I didn't comment to you. Back in the old days, like I told you back in the early 80s when we were charting by hand, those people that did candlesticks by hand, we used a black and white system, meaning when the candle was drawn and it was a positive session or a bullish session, you just left the candlestick hollow. When it was a bearish session or a negative session, you'd use the size of the side of the pencil and color in your candle. So lots of literature you read will talk about black and white candles. So black and white candles are the same as red and green candles. Black being bearish, red being bearish. So the structure of all trade charts is pretty much the same. Their frame is formed on two axes, the horizontal and the Y. Now, if you notice on your screen, I've put together some handouts for you. Okay. There are 1, 2, 3, 5 of them. I've given you a candlestick cheat sheet. Just click the button and download it. It's free. There's no registration. There's no anything. And it's going to give you the most popular candlestick patterns and explain them to you, tell you how to recognize them and see them in your trading. I've also given you a handout on reading financial charts. Okay. Again, it's free, it's full of information, and it'll go over and help you understand the difference between the three, how to do the settings, how to put your trend, how to use your charts. Okay. Then I've given you a guide to chart patterns. Chart patterns are one of the first things you should be able to start seeing on your charts. And we're going to go over chart patterns. Then I've given you the trend following strategy, and the momentum day trading, which are two strategies that use your charts to determine entry and exit points and market trades. So before we move on to how to start interpreting price action, you need to understand that bar charts also have patterns, like I mentioned before. Most traders focus on candlesticks and forget about bar charts. But again, both use the open, the high, the low, and the close. So bar charts have similar patterns, okay? And you can see these different pattern shapes. We have the outside bar, the inside bar, the bearish bar, the bullish bar, okay? And these are used the same as different candlestick patterns. Sorry about that. So we have exhaustion bars, we have exhaustion bar tops, we have Pinocchio bars, Pinocchio bar top. We have, but these have all been long forgotten about as traders have moved over to candlestick patterns. But you should learn them and you should try using bar charts. So a bar chart also include volume, and therefore it is recommended you understand buying and selling volume when reading a bar chart. It takes a bit of practice to get used to reading a bar chart, especially when the price is moving very quickly. Remember, the open is always to the left, the close is always to the right. And you'll start to be able to see these easily. Like I said, when you look at a chart, you'll start to see common price points that are important between those. So now, what is price action? Well, if you're a price action trader like me, you're not so concerned with indicators and oscillators. You're concerned mostly with what is going on actually on the chart. So price action is the movement of an asset's price plotted over time. Price action forms the basis of all technical analysis of a stock, commodity, or other asset. Many short-term traders rely exclusively on price action and the formations and trends extrapolated from it to make trading decisions. Technical analysis as a practice is a derivative of price action since it uses past prices in calculation. So all technical analysis, or another name for technical analysis, is chart analysis. And every indicator you use, any oscillator, any chart pattern is all derived from the same open highs, lows, and closes in volume. So price action analysis is the act of studying, reading, and interpreting the price movement of a market over time, which involves the use of raw price charts to trade the market. That means no indicators, because an indicator is a mathematical calculation or a derivative based on those particular prices, but it's no longer price action because it's a mathematical calculation applied to price action. So by learning to read the price action of a market, we can determine a market's directional bias as well as trade from reoccurring price action patterns and price action setups that reflect changes or continuations in market sentiment. So let's go back to my charts. Now, one of the most important things we get when we read a chart and look at a chart is we start to see what we call support and resistance line. These are levels where price in the past has some type of interaction, and that price in the past, or what has happened in the past at that particular price, can help us observe and make determination about what price might be important today. Like, here we go. This support line I drew months ago and brought it forward. This is from the last time the euro was trading in the 110 area, and this level was an important price that the euro had a problem getting through above, and it kept bouncing off it. Now look at that. I projected it forward, and here we come on this chart. Weeks later, prices rally, and look what happened at that resistance level. As price was moving up from the bottom and look at this when it came down, and it was falling and falling and falling. It came down, and where's the lowest low it was able to find? On a support line drawn from weeks ago. The last time the price was down in this area, what was the price that it had a problem with? As it pushed back up, look at what happened. Pushed to this support, fell back up, pushed back, fell back, then it comes up and gets congested at that resistance level, and then it makes its move through. Okay. It's helping us interpret the market. And this is by looking at charts and price action. This is not with any indicators below. Okay. Also looking at price action, we can add things onto a chart that aren't calculations. So here we have a support and resistance line brought forward from previous highs and lows. We have now on price a formation of a triangle. A triangle is a well-documented chart pattern. It tells us as price moves into this apex of the triangle, it's going to break up out either upward or downward. Okay. But when we get the breakout, we can then make some determinations. This is price action trading. Here we go, is a beautiful, what we call a descending triangle. Now, a descending triangle has a bias. Okay. It occurs during a downtrend, and when there's a breakout, it should continue its downward movement. And we see price moving into this triangle formation. Without drawing the lines, there's no technical way of drawing these lines, just seeing the lines. We can then see price break out of that triangle, and that means that pent-up demand, or the traders have made a decision. It breaks out, we have our confirmation candle, and then we can easily go into a down or a short trade as the price continues back on its downtrend. Now, we have what we call market structure. These are some well-accepted patterns that we will see in our everyday trading that appear in price, that have been documented over time. And this is based on the psychology of buyers and sellers in the marketplace. And this is some of the ways we can interpret price action. Because again, we're only using activity on a chart. We're never taking our eye off to look down below at some type of indicator or oscillator. We're not dropping on support. We're not dropping on things like Bollinger Bands. That's a calculation. We're not dropping down below MACD, which is an indicator and oscillator. We're using price itself to make trading decisions, which for me is the best way to trade, because we're not getting ourselves stuck with some indicators bias. We're never taking our eyes off of price. Price action analysis is the use of the natural or raw price movement of a market to analyze and trade it. This means you are making all of your trading decisions purely on the price bars on a naked or indicator-free price chart. In simpler terms, all economic variables create price movement, which can be easily seen on a market's price chart. Whether an economic variable is filtered down through a human trader or a computer trader, the movement that it creates is in the market will be easily visible on a price chart. Therefore, instead of trying to analyze a million economic variables each day, which is obviously impossible, you can simply learn to trade from price action analysis, because this style of trading allows you to easily analyze and make use of all market variables by simply reading and trading off the price action created by the market. So price action generally refers to the up and down movement of a securities price when it is plotted over time. Different looks can be applied on a chart to make trends in price action more obvious to traders. Technical analysis formations and chart patterns are derived from price action. Technical analysis tools like moving averages are calculated from price action and projected into the future to inform traders. Price action can be seen and interpreted using charts that plot price over time. Traders use different chart compositions to improve their ability to spot and interpret trends, breakouts, and reversals. Many traders use candlestick charts since they help better visualize price movement by displaying the open, the high, the low, and the close in values in the context of up and down sessions. Candlestick patterns such as a Harami cross, engulfing pattern, and three white soldiers are all examples of visually interpreted price action. There are many more candlestick formations that are generated off price action to set up an expectation of what will come next, hence your candlestick cheat sheet. These same formations can apply to other types of charts, including point and figure charts, box plot charts, and so on. The typical price action chart with candlesticks and a bar chart at the bottom showing volume. This is the most popular today. Volume is crucial when making trading decisions and looking at price action, because ultimately whatever price is telling you, if the traders are not supporting it, so you're not, even though your price action is telling you the markets are going down and you should be shorting something, if volume isn't supporting that, means the traders are moving the side because they're not sure it's going to continue down. So for example, an ascending triangle pattern formed by applying trend lines to a price action chart may be used to predict a potential breakout, since the price action indicates that bulls have attempted to break out on several occasions. In addition to the visual formations on a chart, many technical analysts use price action data when calculating technical indicators. The goal is to find order in the sometimes seemingly random movements of price. Now, this is where we go off on the psychological, I guess we could call it. Price is completely random. Price action is based on human beings that are trading the markets. And most of the time, price is totally random. Now, there are certain price times when you look at price that you can see that the randomness has become non-random. This usually occurs during uptrends and downtrends. And when you can spot these non-random times in the market, you can then make intelligent decisions as to what to do. So price action is not generally seen as a trading tool like an indicator, but rather the data source of which all tools are built. Swing traders and trend traders tend to work most closely with price action, eschewing any fundamental analysis in favor of focusing solely on support and resistance levels and to predict breakouts and consolidation. Now, if you think of technical indicators like MACD, RSI, stochastics, all of these, like I said, are calculations. If you think of them as interpreters, when you cannot decide what price action is trying to tell you, or it's a little bit muddied, you can then ask an interpreter. But these technical analysis tools, such as indicators and oscillators, should be your secondary line of defense, not your primary trading method. Interpreting price action is very subjective. It's common for two traders to arrive at different conclusions when analyzing the same price action. One trader may see a bearish downtrend, and another might believe that price action shows a potential near-term turnaround. Of course, the time period being used also has a huge influence on what traders see, as a stock can have many intraday downtrends while maintaining a month-over-month uptrend. The important thing is to remember is that trading predictions made using price action on any time scale are speculative. But let's go back to my charts, because that was an important comment that people skip over. So here we're looking at the euro US dollar. Okay. This is a 30-minute chart, and the euro US dollar is in a very nice defined uptrend. It's actually doing everything an uptrend should be. Push and ease, making higher highs and higher lows. Push to a higher high, leaves back to a higher low than a previous low, push back up, ease back down, push back up. Beautiful trend line, beautiful trend. Okay. So you would naturally think the euro is moving up and that you should be buying the euro. Okay. Now, if we were to simply look at this in a different time frame, we might see something different. Now we see a hardcore uptrend. My trend line is still there, but we see the euro isn't really that much trending up as it is recovering. We go back out a little bit farther, and what do we see that's a lot different? Well, the euro came all the way down to the bottom of a downtrend. Here. And it's simply, maybe it's just simply a recovery phase before it continues its downtrend. But it's moving up, but it's not, it's in a very short-term uptrend. But the weight of the euro has been down. So this tells us something about price, because if the price is climbing, and for a price to climb, it's got to have momentum behind it. But when your overall push is downward, it takes twice as much energy to keep it going up. And the Forex market, prices said that if you measure the decline, you can most likely get the incline. But price will usually recover to the price level that it was at. But this is all what you see on charts. And by using multiple charts from multiple time frames, because if we were to go back and look at the euro on a longer time frame, we see something even more different. We see that the euro has been trending way, way down. It's not even really in a recovery. It was pushed up higher, fell back down lower, and it's just making the waves or the cycles of a very strong downtrend. But this has all been determined by looking at price action in different time frames, but only by price action. So The more tools you can apply to your trading prediction to confirm it, the better. In the end, however, the past price action of a security is no guarantee of future price action. High probability traders are still speculative traders, which means traders take on a risk to get access to the potential rewards. So there's many strategies that are based on price action. We have our inside bars, we have our indecision candles. We have lots of ways, but to keep it simple, there are 5 ways to read price action and charts the easy way. Being able to read a price action chart is important to make the right decisions. So we could look at our swing highs and swing lows. That's the top of the high of the candle and the bottom and the low of the candle. Okay. So whenever I take a look at the market, I start by analyzing how swing highs and swing lows manifest on a chart. Then we add support and resistance lines. Support and resistance areas are local structures which show previous reaction points. Support and resistance levels areas are usually used to find high probability turning points or breakout points. Then we use price action wave analysis. That's what we were just kind of using when I talked about seeing the leg of the wave or the cycle. That's wave analysis. Wave analysis is often overlooked topic in technical analysis. And when you hear the term waves, you'd typically think about an Elliott wave theory. However, there is much more to wave analysis. When it is combined, wave analysis with support and resistance, swing highs and swing low concepts, you are already looking at a robust method of predicting market analysis. Then add on your trend lines. Trend lines are arguably more subjective because drawing trend lines is more of an art than a science. When it comes to using trend lines, I suggest you focus on 2 main concepts. The initial break of the trend line, which can signal a shift in direction, and a retest of the trend lines as a safer entry point. And then moving averages. Moving averages are another great confluence tool. There are 4 main ways to use moving averages to make sense of charts and times. We have entry filters, what we call a lot of times green light, red light. You would only take a long trade above a moving average and a short trade below a moving average. We can also use it as a support and resistance tool. We can also use it to time our entry points. And a moving average crossover can foreshadow a market transition period. So there's many ways we can use moving averages, but all 5 of these tools we talked about are only tools that are used on type of price with price exactly, on a price chart. They're not indicators that are using mathematical calculations and then removing you from price. Price action trading is a trading methodology that uses the movement of price as inputs for making trading decisions. It allows you to tell a story of what the price is doing and making higher probability trades based on that story. It is a form of technical analysis. As we mentioned, price action trading revolves around only using the price of a security to make informed decisions on what the market might do. But that doesn't mean we can't look at it in different ways. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. Make sure you download all of those guides I gave you. And thank you for supporting AvaTrader. If you have any questions, just go to www.avatrade.com. That's AVATRADE.com. And contact your customer support, and they'll be glad to answer your questions for you, set you up their academy. You can use some of their tools there and some of their education materials and learn more about price action. Have a great night now, and thanks for supporting AvaTrade and investing.com.